Hi students, good evening. Today we are discussing some of the concepts related to the transactions. In the earlier videos we have discussed about the basic transaction like the debit and the credit, some of the sales transactions, some purchase transaction, the investment transactions, then the expenses and all the basic one. Today we will focus on the transactions which are related to the credit transaction. So the concept is related to credit transactions. Credit transaction means what? That any transaction which is not related to the cash, which is not based on the cash. So any credit transaction. It may be we are selling the goods on the credit basis, we are purchasing the goods on the credit basis, maybe we are purchasing the fixed asset on the credit basis, or there is a possibility that we are taking a loan from the bank. So everything that is related to the credit, so we will discuss those transactions, and then we will also discuss that if the sales are there on the credit, when we will receive the money, so what will be the effect. In the same way, when the purchases are on credit, when we pay the money, what will be the effect in the form of the debit and credit. There may be possibility of the discount also, there is a possibility of the bad debts also. So we will discuss some of the basic concepts related to the credit transaction. Okay, so we will just start with the first one. Sales on credit to Mrs. Bengals, we have made a sales of $300 and that sale is on the credit basis. So here, what will be the effect? We have to see that we have two effects are there. First of all, there is a sales is affecting, and then we have a receivables. So the two effects are there. Account receivables, or what we say the debtors are there. That is asset, and there is an increase in the asset. Okay, and the second effect is on the sales, and the sale is revenue, it is also increasing. So we have two effects are there. First of all, the receivables, account receivables, we can say the trade receivables, we can say. So that is increasing. Increasing means that we have to receive the money. The credit terms are like a 5 days, 10 days, 20 days, depending on the transactions, that how they is agreed with the customer. Now the customer name is what? That is the Mr. Bengal is there. Now the second thing is the sales or the revenue is there. So account receivable is the asset that is increased, and then the sale is the revenue that is increased. Now we have to see what are the main debit and credit effects are there. First of all, account receivable is the asset. Asset increase is what? That is the debit one. The second one is the sales. Sale is our revenue, and that increase in the revenue is the credit. So we have a one debit and we have a one credit. So now we can record this transaction. So in the same way, we will write the date. It's the first of any month. So just assumed value is there, assumed date is there. So we will write here the account receivable, or it is the debtors, and that is Messrs. Bengal. And then we have a sales account, and the amount is $300. So that is sales on credit. So the first transaction, that is the sales, and the sale is on the credit basis. Receivables, the debtors are increasing, that is debit, and then the sales or the revenue is also increasing, that is credit. So sales account is credited, receivable is debited. So any sales, either it is a cash sales or credit sales, the same entry will be passed. Now the next thing that we have a possibility is that this person may give you the money after 5 days, after 10 days, after 15 days. So now we have to see that what is the effect when we are receiving the money from that customer. So we will record it like that on the second one. For example, that is on the 20th, like after 20 days there is a creditor and Mr. Bengal or Miss Bengal has given us the 300 amount. So there is a possibility that they give you the 100% amount, means the 300 real or the dollar as a total. Other possibility is what, that the person is not giving you the 100%, they may be giving you the 50%, or there is a possibility the remaining amount they will give you later on. Or there is a one more option is there, that there is a possibility of the discount you are giving. Discount means, for example, instead of 300, they are not giving you 300, they are giving you like a $290 and $10 you will give as a discount. So we will discuss all these transactions one by one. The first option is what? Versus Bengal paid $300. So first option, number E option is that they have given you, the customer has given you the 100% amount on the 20th. So we will consider like this. This is on the 20th. So what we will receive, we are receiving the cash, and the cash is asset, and asset is increasing. And what is the second effect? The account receivable, that is also the asset, and it is decreasing. So asset increasing, asset decreasing. One asset will be on the debit side, and the other asset means what the receivable was, it is decreasing, so that will be on the credit side. So the simple transaction we can write here as the cash account, or the amount we have received in the bank account, so that will be debit 300, and then we have a account receivable, that is the debtor, that is Messrs. Bengal $300. So here we are receiving immediately after 10 days, 15 days, 20 days, but we are receiving the 100% cash. So this is the first option is there, that all the money that we have received in the form of the cash, and there is no discount, there is no bankruptcy, there is no insolvency, there is no partial payment, 100% amount we are receiving. Okay. Now the second option may be like that, instead of 300, the person is paying just let's say $290. Why $290? And when we are receiving $290, it means cash we have received 290, but our receivable was 300. So where is that $10? That $10 we have to see here, either that is the discount or any other reason. We say just as a full payment or we can say as a final payment. So that $10 is what, that is the discount. Okay. Now the discount is the expense for the business, and it is increasing. So now instead of two effects, we have now three effects. Obviously the cash we are receiving, that will be the same, that is the asset is increasing, that will be debit. The account receivable, that is credit by 300. Now the difference of $10, that is what, that is the discount, because instead of receiving $300, we are just receiving $290. It means we are giving him a discount. It is expense for us, it is a loss for us of the $10. So any expense increase is the debit. So now we have two debit effects in the transaction, and then we have what? We have one credit effect in the form of the receivable. So we can say this is the second option on the same 20th instead of that one. So on the 20th, the second option we can write like same, we are receiving a cash account, okay, or maybe we are receiving in the bank account, but we are not receiving 300, we are receiving only $290. Okay. Then the second effect is on the discount expense. that is $10, and then we have a account receivable, the debtors, and we have to mention the name of Miss Bengal, that is 300. So that is full, or what we can say like a final payment by customer. So now if you look at these two options, or two different, you can say the possibilities are there. First of all, the person has paid 100% amount without any discount, without any partial payment. So in that case, cash is debit. Here, instead of 100% payment, the person has given you only $290 because you have given him as a customer $10 discount due to the early payment, or due to any transaction effect, or any other settlement with the customer. So you are given $10 discount. So that $10 discount is on the debit side. So here cash 300, but here cash only 290. So receivables on the both transactions are same. So receivables credit 300, receivable credit 300. Only difference is that $10 instead of $290 plus $10, so you are receiving here 300, and here instead of $300 you are receiving only 290, and $10 you are giving as a discount. Okay. Now we can have one other option, that can be that $290 the person has given you, or it may be any other amount. We can say, like, for example, the person has given you only $200 as a final payment. Now final payment means now after that the customer will not pay you anything else. Now what will be the effect? Obviously here instead of 290 we have only $200, but receivables again, because it is a final settlement, there is no other receivables after that, the balance will be nil, so it will be 300. Now here we have to analyze that what is this, the difference. The difference here is $10, but this is not a discount. Okay, so while the person is giving you $200, because the person may be declared as the insolvent, okay, or it may be a bankrupt, means you have to receive totally $300 from that Mrs. Bengal or Miss Bengal. Now, but instead of that, they have given you just how much? Only $200. And it is a final payment, there is a final settlement is there, and after that the person is not able to pay you even a one single dollar. So it means you will receive only $200, and $100 is the loss for you. And this is what this is called as the bad debts. And the bad debt is what there's a possibility sometime that your customer is insolvent. Insolvent means what? That due to the losses in the business is closed, and he has or she has been declared as the bankrupt or the insolvent by the court. So now you cannot receive any extra amount from that person. So this is the final settlement. So this $100 is again the loss for you. So that loss will be considered as what? As the bad debts. So we can write it as a bad debt write-off. Because these $100 you are unable to receive from that person due to that bankruptcy or insolvency. There is other possibility also. For example, there is a possibility, let's say the person, your customer, died, and he or she has no like a hires or their legal hires or anything else, so you are unable to receive the money from that person, or the person is insane, or any other legal, or the person may be a fraud also, so you are unable to receive that $100. So in all these cases, this $100 is the loss for you. This is basically the expense for you. So it is written directly as a written off. It is written from your accounts. So now the transactions will be like a cash account debit, or in the same way like a bank account debit. How much? Only $200. Then there is a bad debt, that is $100. Bad debt obviously will be loss, it will be expense. And then in the same way, the receivables, the debtors versus bank. So now final payment by customer. So that will be the receivable is credited by how much? That is $300. So this is the C option. So we can say the third option, the C option. So if you see here, just we go through the same transactions that there is a possibility that you have sold the goods on the credit to West Bangers for $300, but there is a first possibility the person has given you the 100% amount, $300. So here, this one is what? That is basically the full payment the person has given you. Okay. So here we can say no discount. Okay. The second one is what? This is with discount. And here there is a possibility of the loss. So we have three options are there. Obviously one thing will happen, not all these are the same thing. You have sold the goods to Mrs. Bangles for $300. The first option is that you can say like this is the option number A, or possibility number A, that the person will give you 100% amount. There is no discount given by you. So on the final date, on the settlement date, on the due date, the person has given you $300. So you will debit the cash account or the bank account as a debit, and then the receivables will be credit. Okay. Or there is other possibility, there is other option is available, that instead of $300, there is a possibility that you have given him a discount of $10 because the person is giving you the amount before time or before that period that you have given to the person, the final date. So you are giving him a 10% discount. So this is a loss for you, this is the expense for you. But in this case, the person will give you only $290. So $10 you have given him a discount for the early payments. So cash will be debit, discount expense will be debit because it is also expense for you, and the receivables will be again the credit. So in all the conditions, receivable is same 300, that is credit. Now the third option is that instead of $300 you have just received $200, and $100 you are unable to receive because the person is declared as insolvent, or person is declared as bankrupt, or due to the death of the person. So you are unable to receive this $100. This is not according to your will. Okay, you don't want to give that discount or anything else, but here it is what it is. You are compelled for this $100 loss for the bad debts. So again here the cash will be debit, but instead of the discount here we have a bad debts because this is a loss for you. You are unable to receive the money on the due date, so that bad debts will be there, and the receivables will be the $300. The same here, all these options, either one or A option, B option, C option, receivable is same, credit by $300 as a final settlement. But the cash in first condition is $300, no discount. The second option, $290, $10 discount. Okay. The third option, you receive just $200, and $100 is the bad debt expense. So the third option is also the possibility of the bad debt. So one sale transaction has three different options available for the receipt of the payment, 100% amount, some cash discount is given, or there is a possibility of the bad debts. Okay, the second possibility that we have, or the second transaction that we are going to discuss, is related to the purchases. So here there is a purchases. Purchases means what? The purchases of the goods which are for the reselling purposes or for the production purposes. The company is purchasing or the business is purchasing the goods. So purchases are there, okay, on the credit basis, and from whom? Purchased on credit, basically from Messrs. Nikon. The amount is how much? That is $400, and that is what? That is basically the goods, okay, or what we say, the inventory, or what we say, the stock. The goods or the stock or the inventory purchased are there, and that is $400, and that is on the credit basis, and the name of the supplier is what? That is Messrs. Nikon. Now, first of all, we have to record the purchases transaction. So here we have two effects are there, obviously. First one, what? That is the purchases account is increasing, and account payable, or what's here, the creditor, and that is what? That is the liability, that will be credit, and again that is also increasing. So purchases account increasing, and the payable account is also increasing. So purchases account will be debit, and the payable will be credit, because the goods are increasing, so that will be on the debit side, and the payable or the liability is increasing, so that will be on the credit side. So first we will record this transaction. So we will write like a purchases account debit, we have a amount of $400, and then we have a account payable creditors, that is Messrs. Nikon, that is $400. So purchase goods on credit. So first of all, we are purchasing the goods, and we are purchasing the goods on the credit basis. Now we will discuss what are the other options are available related to that transaction. So first option is that we receive all the we pay all the money to the supplier, $400. Okay, now we have a first option we just discussed on the 20th. We are paying $400 to Messrs. Nikon on the 20th of the due date. Now the 20th is the due date, so we are paying all the money of $400. So this is the first option. So we will again discuss like a sales. We will discuss three options, that what are the possibilities of the payment. So here what is happening, we are paying the cash. So cash is decreasing, and account payable or liability is also decreasing. So cash is what? That is the asset, okay, and account payable is what? That is the liability. So asset is also increasing, and the payable is also decreasing. So in both cases, receivables is increasing, so you are paying the cash, so cash is decreasing. So in the same way, the liability, because you are paying the amount, here the liability was increased, now you are paying the amount, so liability will be decreasing. So asset is decreasing is credit, and liability is also decreasing, so that will be debit. So first of all, the very basic transaction, that we are paying the cash, so account payable, the creditors, Messrs. Nikon, that will be $400, and cash account, or it may be like a bank account, that will be 400. So paid to supplier. So $400 is paid to the supplier, means 100% amount is paid on the due date. So this is the first possibility. Now instead of this, we can have some other possibilities are there. But maybe the other possibility that, for example, the company is not giving them a $400, they are giving them like a $380 now, but as a final settlement. Now there's a possibility because you are paying the money on time, or you may be paying the money before time, before the due date. Let's say there's a 30 days time period is there and you are paying on after 20 days. So with negotiation or due to any other reason, the supplier is giving a discount of how much, that is the $20 discount is there. Okay, now this discount you are receiving, so you are paying only how much? $380. But after that, obviously, your payable, your liability will finish, it will be finally settled. But instead of $400, you are only paying $380, and $20 is what, that is the discount that you are receiving. It is an income for you. Okay, so now this $20 is the discount income. Okay, and the discount is increasing. So here the payable is decreasing by 400, but you are receiving a discount of $20, and the total amount you are paying is only $380. So discount income is like any other revenue. So any increase in the income or the revenue is the credit, as the basic rule of the accounting. So here in the B option, or what we say the second possibility, we can say like a cash you are paying. So but the payable, the creditor Messrs. Lycon will be debit with the same amount, because you are unable to pay the 100% amount. Why? Because they have given you the option of the discount. So but your possibility or the total settlement is there, so there is no other payment you have to make after that. So it's a final settlement. So $400 is the amount that you have paid. Now the next thing is what, that is the cash. Okay, cash or through the bank you are paying, but you are paying only how much? $380, and the other amount is the $20, that is the discount income. That is $20. Now the first option is that you are paying the 100% amount to the supplier. So your creditors is debit by 400, your payable is debit by $400, and then the cash is credited by $400. The second option is that instead of $400, you are only paying $380, and $20 discount you are receiving from the supplier. Okay, in both cases the payable is debit and the cash is credit, but here the difference is only in the amount of the cash. Here $400 you are paying, and here you are not paying $400, you are paying only $380, and the discount is $20. What you are receiving is your income. So here we will also write the same narration paid to supplier. Then the third option may be there, that for example we can write here like as option number C, that you have to pay $400 to the supplier, but you don't have a $400 and you just make like a 2 or 3 installment with that. Okay, you will pay the amount, the remaining amount, the balance amount after some time, but currently you are paying only, let's say $100 or $200 is there. So we say like paid to Messrs. Lycon like $150 as first installment. You have negotiated with the supplier and they say, okay, no problem, this is the first installment, the second installment, third installment, like you are paying $150 first, $150, then $100. Okay, so after 20 days you are paying the first installment. So these are the installment you have agreed with the suppliers, and they are saying okay, no issue with that. So the C option is that you're not paying the 100% amount, you're paying the first installment only of $150. But the remaining amount, like you have a 400 is the payable, you have to pay the remaining amount, but not immediately. You have to pay it in the installment. Maybe this is installment after 20 days, this after 40 days, and this after 60 days. So here we have the first 20 days are there, so you are paying the amount first installment of out of $400, only $150. So here the account payable will be debit, the creditor, that is Messrs Nikon, okay, and then you are paying the through the bank or through the cash, so cash or the bank will be credit, but this is the paid first installment. So here you will write only $150 like a first installment, because this is not the final payment, this is not the final settlement. So you have to pay other $150 after 40 days. You have to pay the remaining balance of $100 off. That will be the final settlement at the end of the 60 days. So this is the first installment. So here the credit or the cash is only credited by $150, and also the creditors or the payable or the liability is reduced by $150. So if you see here, just like a previous transaction that we have with respect to the pay receivables, the same way we have a three option here with respect to the payable. The first option, we can say this is the full payment. You have paid full here. How much? $400. Now, or there is a possibility that you are not paying the full amount, you are getting some discount. So this is the second option. So instead of $400, you are paying only $380, and you are receiving a discount on that $20. Or there is a possibility that you are paying the amount in the installments, like a one installment, second installment, third installment. So first, second, third installment is there, or there may be only two installments depending on the agreement with the supplier. So here we have a first option, you are paying 100% amount, that is $400. The second option, you are getting a discount, the cash discount of $20, so you are paying only $380. And the third option, you are paying only the first installment to the supplier, only $150. So we have option number one, like option number A, option number B, and option number C. So if you go through that all transactions or the possibility of the transaction, the basic transaction was that you have purchased the goods from the suppliers on the credit. So your payable is, or your liability is credited by $400, and the purchases or the goods account is debited by $400. Later on, the first option is that you pay the 100% amount after 20 days. So what happened? The cash or the bank account is credited and your liability is finished. Now the second option, or what we say the B option, is that you are not paying the 100% amount, you are getting some discount from the supplier, the $20 discount, so you are paying only $380. And then the third option is also there, that instead of all the amount of $400 settlement, you are paying the amount in the installment, and you are paying first installment of $150. So here the payable will be only debited by $150, and the cash will be credited by $150. So if we see here, it means still you have to pay how much? $250 is still payable. Means the balance of the payable is still $250 there. You have paid only $150 out of $400. So still payable is $250 is your liability still in the account, so which you will pay after 40 days or 60 days in the different installment as agreed with the supplier. The third type of the transactions we are discussing in the credit transaction is the purchase of fixed asset on credit. Now, I hope you remember the concept of the fixed asset. We have a land, we have a building, we have any furniture, we have a machinery, we have any vehicles or any fixtures or any equipment or even the computers or any tools, all will be considered as the fixed asset which has a life of more than 1 year. The useful life is more than 1 year, and that is purchased by the company for the or by the business for the use, not for the resale purposes. Okay, so let's say the company is purchasing the furniture of $3,000 on credit. So you're purchasing a furniture, that is the fixed asset, and you're not paying the cash immediately. You are some agreement with the supplier that you will pay after some time. So that's why you are purchasing that furniture of $300 from Messrs. X Furniture, and the amount is how much? That is the $300, and you will pay like a 3 installment or 2 installment, like a first installment of $1,000 and then the second installment of $2,000. So that will be after 30 days and that will be after 60 days. That is the first installment and that is the second installment. So this amount, the total $3,000 is not paid immediately. You are paying the amount into the installment. So in this case, the transaction will be same as we have already discussed in the purchases of the goods. So there will be no difference. Only difference will be that instead of the debit of the purchases or debit of the goods, we will debit the furniture account, and then the cash account will be credited in both cases, either it is a purchase of the goods or purchase of the furniture. So we just go through the transaction. So very simple one, the furniture account debit, and then we have a account payable, that is creditors. Okay, and then that is the X Furniture is the company name. The amount is how much? That is $3,000. Now the first installment, that is on the 30th, that the company is paying. So what will happen? They have to pay the cash. So the cash here, when they are making the first installment, the payment of the installment, so the cash is reducing and the liability in the form of the account payable is also reducing. So the cash of the firm is reducing and the liability in the form of the payable is also reducing. So if the liability is reducing, we have the debit. If the liability is decreasing, it is debit. And if the cash is obviously the asset, and if it is decreasing, so that will be credit. So we have a one debit is there, one credit is there. So we can write here like account payable, the creditors, X Furniture. So you are paying the first installment of $1,000 and then the cash account of $1,000. So paid first installment. Okay. So that is the very simple transaction, the same transaction as it was in the purchases of the goods. Now we have another option is there, that the supplier is agreed to give you the credit, but that is credit is not interest free. For example, okay, they're saying that they will charge you like a 5% interest on balance. Means you pay the first installment, that is okay without interest, but whatsoever is the balance, like a 2,000 amount is the balance which you have to pay after 60 days, but they will charge you what? They will charge you the 5% amount on the balance as the interest, and that is not on the monthly basis, that is on the total amount. We are not considering for 1 year or 1 month or whatsoever. We are just considering they will charge you 5% extra on the second installment. Why they are charging you the interest? Because you are paying the first amount after 30 days, but the second amount you will pay after 60 days, $2,000. But they say because you are taking more time, so you have to pay some extra interest. Let's say this interest is a 5%, and we say like a $100 you have to pay extra as a interest. Obviously, the calculations we will do later on, and even according to the agreement. But we just assume that the extra interest or extra amount what you are paying is $100. So now you don't have to pay $2,000. You have to pay $2,000 as the principal amount and $100 as the amount as the interest. So the total payment you have to pay is the $2,100. So this is the second possibility. Like after 60 days, you have the, like on this is for example 30th January, and this is the 30th or the 2nd of the March is there, for example, or 30th March is there. So you have to pay the remaining amount $2,000, but that not will be only a principal amount, but you have to pay something extra because you are paying after 60 days. The next 60 days are there, so that's why. So here the amount as a payable to the creditor, that is X furniture, that is same, that will be $2,000. So you have $1,000 already paid, your total liability was $3,000, and now you are paying your liability as a $2,000. So $2,000 will be your account payable or the credit. But the amount which you are paying in the form of the cash, that is $2,100, because this is the amount you are paying as a cash, and 100 extra you are paying what for the interest. Why? Because you are taking long time to pay your liability, so that's why they are charging you the interest. It is agreed by the supplier and the customer, so that's why you are getting $100 as a expense of the interest. So it means here the debit and the credit is not equal. So the difference is what? That is the $100, and that $100, because this is the interest, 5% interest or the extra amount. So this is the expense for the business, and expense increase is also a debit one. So we will write here as a interest expense, how much? $100. So it means after some time, if you are paying like a first you have paid $1,000, the second amount you are paying is what? Is not the original amount you are only paying, you are also paying some of the interest as per the agreement. So your payable will be debit by $2,000, but $100 you are paying as a expense, as a interest expense, and the total cash you are paying is $2,100. So we will write the narration here: paid second installment with interest. So $100 you have paid extra as the interest. So this was a small difference from the previous transaction, because in the previous transaction there was no interest. You are paying only the original amount or the principal amount to the supplier, but here there is a small difference is there. And just we go through this transaction. The first transaction is what? That you have purchased a furniture from Messrs. X Furniture, the company name is X Furniture, and 3,000, and you made an agreement with that you will pay the first installment after 30 days, and then after 60 days you will again pay the second installment. That second installment will not be interest free, but you have to pay something extra. Let's say $100 you have to pay extra. So when you purchase the furniture account is debit by how much? $3,000, because that is the asset. So now the second thing, because this is the asset, I'm just writing it for the understanding, not in the transaction obviously, and this is what? This is the liability, the first transaction. Now we have a two option is there. The first installment is there, that is, and the second installment is there. The first installment, $1,000 you have paid, your liability is reducing. The first installment is paid in the form of the cash without any interest. So the cash is credited, and then the account payable or the furniture, here it was debit and here it is credit. Here liability is increasing and here liability is decreasing. Okay. Now the third transaction that we have, that after 60 days, the last installment or the second installment you are paying is the $2,000, but they are charging you 5% interest or the $100 interest extra. So it means that you are paying not only $2,000, but you are paying $100 extra. So here you are paying $2,100 cash. So here cash was credited, it's the asset is decreasing, it is credit 1,000. Here cash is reducing, it is decreasing by $2,100. So the liability here again is decreasing, and the cash as an asset is also decreasing 2,100. So the difference of $100, because you are paying interest, that is the expense, and expense is increasing for $100. So this is the transaction which is not an interest-free transaction. The second installment you are paying something extra for the interest. So first transaction by the purchase of the furniture. The second transaction, the first installment you have paid without interest, and the second installment you have paid with interest. So this is the basic understanding of the any asset or anything you are purchasing on the installment, but you are maybe paying with some interest, some extra amount. So calculation here we have done just a basic one, the simple $100 as assumed value. It may be more or less according to the supplier and the customer agreement. So you agreed to pay $100 extra for that delay for the second installment. So it will be handled in the account like that. So this is the expense for you. You are paying, instead of 3,000, you are paying 3,100. So $100 you are paying as the interest expense. So this is the understanding of the interest, how it is considered in the books of the account. So I hope you have understood the transactions today. First we discussed the transactions related to the sales transactions, credit sales transaction. Then we discussed to the goods which are purchased on the credit basis. And now in the third one we have discussed just related to the fixed asset purchases on the credit basis, but that is with the interest. I hope you have understood that, but still if you have any confusion, if you have any doubt, you can ask me in the comment. I will wait for your comments. Thank you very much.